Hi guys, welcome to CADS 3853 module number 20. In this module, we are going to talk about the 6-month plan, which is the culmination of everything that we have learned so far in this semester. In this module, we're going to do something a little bit different from the previous modules. We are going to actually work on the module problem assignment simultaneously while watching the video. Okay, so I would like you to, if you haven't already, please print your module problem assignment number 20 and have it in front of you, or have it on another screen or another window so that you can work on it while we are actually watching the video. So the structure of this video is going to be that I'm going to explain the concepts and I'm going to kind of show you some example of each step of the 6-month plan. And in each step, you're going to work on the module problem assignment for the corresponding step of the assignment right after hearing and seeing the example. In addition, the video is going to also share some partial answer key. So it's not going to give you answer key to every section or everything in the module problem assignment, but it's going to show some partial answer key so that you can make sure whether you were going through the right steps and using the right formula and things like that, and apply the same thing for the rest of the section. So in summary, basically, in this module, we're gonna watching the video, which explains the concept for each section of the 6-month plan, and also show the example how to work on that section of the 6-month plan. And then you switch to your module problem assignment and also work on the corresponding section of the 6-month plan in the module problem assignment. And then you go back to the video and can check the answer key, the partial answer key, so that at least you can be sure that, okay, I applied the right formula for this part, and things like that. If you didn't, then you can rework on it. Okay, so that's the way it's going to work in this module. So it's very important that you have the assignment up. So let's pause the video and either print the module problem assignment number 20 so that you have it in front of you, or you can open the file on the computer so you can flip back and forth between this video and the module problem assignment and work back and forth during the entire video play. Okay, all right, so let's move on to the module lesson. All right, let's talk about merchandising plans. The 6-month plan is part of the entire merchandising plans. When we do plan merchandising, we do plan a lot of different things. And the first thing that we plan is how much merchandise we are going to have. So that includes, how much sales we have to make and how much inventory we need to keep, and how much purchase that we need to make to be able to support the sales and to support the inventory need that we have. And we do this for every month throughout the 6-month season. Okay, a season has 6 months, and we plan these things for each month. And that's why we call it 6-month plan, or sometimes we just call it merchandise budget plan. Then we have to have some pricing plans. So for how much we're going to sell our merchandise. Right, like that will include like a markup plans and markdown plans, like reductions, all those kinds of things. And once we have the dollar plan, the budget plan, then we can actually further plan the kind of merchandise that we are going to purchase for these dollars, right? So how are we going to actually use this merchandise budget into a specific line of merchandise, the assortment or the modern stock plan that we call. And we're going to talk about these assortment planning or modern stock planning in another unit later. Then we need a plan of the actual purchase plan. So, how much we're going to buy and when. And that's kind of part of the merchandise budget plan or 6-month plan, but then it gets down to specifics for any time period, any point in time, how much is left for you to purchase more for the remaining month and things like that. And that's what we call open to buy or OTB. So that has to be planned after the 6-month plan is done. This open to buy plan is more like an ongoing planning. You continuously monitor and track how much open to buy is left for each month as the season goes by, and as you start to purchase stuff, and you keep calculating how much still is left for you to purchase more and things like that. So that is kind of the things that comes after the 6-month plan. Then finally, you also have to have some shipment plan, when you're going to actually have this merchandise in. When you buy and when you have the merchandise are two different things. You don't get the merchandise as soon as you buy it. So you have to have the delivery plan or shipment plan so that you know when you're going to have a certain merchandise. Okay, so as I said earlier, the 6-month plan or the merchandise budget plan basically answers the question of how much merchandise do we need, right? Because it gives the dollar plan. The 6-month plan is a tool to translate our profit goal into the actual merchandise dollar budget plans. And in the 6-month plan, we specify a lot of important numbers, right? The dollar numbers that the buyer needs to adhere to when planning merchandise. And that includes a lot of things, such as sales for every month throughout the 6-month season. Reductions can include like markdown, sales discounts, and shortages and things like that. All combined, how much reduction dollars we are going to need to take in each month throughout the 6 months. And the inventory levels. What would be the BOM, beginning of month inventory level, or the EOM, end of month inventory level? Okay, we're going to plan those things. And in the 6-month plan, the purchases will be planned. So based on the sales, reductions, and inventory level planning, then how much merchandise need to be purchased for every month. And then we can also add the open to buy, but that open to buy is not always going to be part of the 6-month plan. And like I said before, open to buy a lot of times comes after the 6-month plan. Then the next question is, why do we need to plan for entire 6 months? Why can't we just go and purchase what we need at a time and things like that? That's because there are a lot of benefits, right? It could be some operational benefits as well as merchandising benefits. In an operational sense, having the 6-month plan allows the owner of the store or the merchandiser to be able to estimate the capital needs. Capital need basically means, how much money do we need to go ahead and purchase stuff, like to invest in the inventory, right? So that you can actually anticipate the cash flow needs, right? So how much sales you will need to be able to generate this cash, or if we have to borrow money from the bank or someplace like that, then, when do we need to borrow and how much? And, that kind of anticipation and projection is possible. And then you have the plans so that you can always compare your plan against your actual actions and the actual operational performance. And if there are any problems identified through this comparison, then you can take corrective actions as soon as possible. So these are all the operational benefits that the 6-month plan can give. In addition, the 6-month plan has a lot of benefits for merchandisers, especially because the plan allows us to have the dollar budget to take to the market. So when you go to the market to make purchases, you're not blind, right? You know how much dollar you can spend and for when you have to purchase this merchandise, all those things. So your purchases are going to be more accurate and more planned. Another benefit of having the monthly plan, the 6-month plan, is that at any given point in time, you can calculate the open to buy. How much more you can purchase, given how much you should purchase for the month and how much you already have purchased. So that is a huge benefit for merchandisers. Another benefit for the merchandising is that the 6-month plan gives the numbers, the data that you can take to the upper level people, like, the general merchandise managers of the company, so that you can negotiate for some needs for, additional sales allowance or markdown allowance, floor space, selling personnel, whatever you need the resources for. You can take this dollar as the evidence for how much dollar you want to actually be able to generate, and given this, you need this kind of support. So it gives you the facts and data that you can use for negotiations, which is another benefit of having a 6-month, like a long-term plan. So then let's see what exactly constitute the 6-month plan. So what numbers are exactly going to be planned through this 6-month merchandise budget planning? Okay. First, we are going to plan sales, and that is including the seasonal total sales volume as well as each month, the monthly sales for the 6 months. Okay. So for monthly sales, we're going to first have the dollar plan as well as the percent to total seasonal sales. So, out of the seasonal total sales, in each month, how many percent of the seasonal total sales will actually occur in each month. That kind of information has to be planned through the 6-month planning. Then we plan reductions. For reductions, we plan the seasonal total reductions dollar. So how much in the entire season we're going to have to reduce through markdown, sales discounts, and shortages and things like that, as well as the monthly figures, right? So monthly dollars, that reductions dollar, as well as the reductions percent of the total seasonal reductions. So out of the total seasonal reductions, how many percent will occur in each month, as well as another percentage figure, the percent of monthly sales, which means given the reductions dollar for the month and sales dollar for the month that are planned, then how much percent of the sales of the month will be reductions. Then we plan the stock level for both VOM and EOM for each month. For each month, what's the beginning of month and end of month stock levels are going to be. Then, given the sales reductions and stock planning, we are going to plan purchases. Okay, again, for each month and the seasonal total. And we want to know the purchases dollar in both the cost value and retail value. All the other numbers are retail value, but we also want to know the cost value of the purchases, because the costs are what we actually end up paying, right? So that allows us to know the capital needs, the cash flow, and things like that. So we want to calculate purchases at both the cost value and the retail value. And finally, given all these plans of the sales reductions and then inventory and purchases, now we want to have an idea about what markup we are going to be able to achieve, maintain, if everything goes as planned, right? So we are going to calculate the maintained markup percent in dollar for both each month and the seasonal total. And the maintained markup is similar to gross margin, right? As long as there's no cash discount and alteration cost, maintained markup equals the gross margin. And for that reason, this is a very important piece of information that we want to have calculated for the entire 6-month season, so we know eventually how much gross margin we're going to be able to achieve. Before we get down to the specifics of the 6-month plan, let's first try to see if we understand the merchandising calendar. The merchandisers operate in a different calendar from the regular lay people's calendars, right? For merchandisers, a year consists of 2 seasons. It doesn't have the 4 seasons like the regular calendar. We have spring season and fall season. Okay, the spring season includes both spring and summer, for example, and usually the spring season starts from February and ends at the end of July. So February through July is the spring season. And the fall season starts in August and finishes at the end of January the following year. Okay. So since a season consists of 6 months, which correspond to 26 weeks, a year has 52 weeks, right? So entire years are 364 days, which is 52 weeks, okay, instead of the 365 days. And if you take a look at the season down to the quarter level, then a season has 2 quarters, right? But each quarter has 3 months. And those 3 months are pretty particular. If you look at the circled part of this screen, the first month has 4 weeks, and the second month has 5 weeks, and the third month has 4 weeks. So 4, 5, 4, okay? And that's repeated for the second and third and fourth quarters in the year. So it keeps going 4, 5, 4, 4, 5, 4, 4, 5, 4, 4, 5, 4, and etc., right? So it's very different from the regular calendar, which, maybe having a 28 days for February and then 31 days for March. It's kind of like a little bit less than 5 weeks. And then April has 30 days, again, less than 5 weeks, a little bit over 4 weeks, that kind of thing. But we have a very specific defined number of weeks for the months, so 4, 5, 4. This is another view of the merchandising calendar, and you can still see that 4, 5, 4, 4, 5, 4 weeks, that repeated for the 4 quarters, right? On this calendar, you can see some of the boxed dates. Like for February, you have 12th, 14th, and 16th boxed out, okay? And you've got some of those things all the way through. What would these boxed dates indicate? Yes, you probably guessed right. Those box dates are holidays, right? So the reason why we want to have like the predetermined 4 weeks, 5 weeks, 4 weeks, that kind of number of weeks for each of these months in the quarter is because we want to make sure that we are going to have the same number of Saturdays and Sundays in every year, okay, for the corresponding month. Okay, so for February, we're going to have 4 Saturdays and 4 Sundays. And then those boxed holidays are going to be exactly, so on February, there are 3 holidays. And the next year, we're going to still have 4 Saturdays, 4 Sundays, and 3 holidays. The following year, the same is going to be the case. So we are trying to make sure through this kind of a modification of the regular calendar to adjust to the merchandising calendar, we're trying to make sure that in each month across different years, we're going to have the same number of weekend days, like Saturdays and Sundays, as well as the same number of holidays across different years. And the point of making it that way is to make this planning process more comparable across different years. So it's compared to what happened last year, what's going to happen this year. When you project the sales and reductions and things like that, as long as you've got the same number of days in a year, in a month, and the same number of holidays included in that month, you can pretty much project the sales based on what happened last year with the concept of, probably there's going to be an increase or decrease based on the economic or other environmental circumstances, right? So it's important for us to know why merchandising calendars are the way it is that they are now, and in the way that is different from the regular calendar. And those holidays and weekend days are high volume days, and if you have different number of those holidays or weekend days across different years, it's going to be very tough for you to plan things based on the history. So that's why. Okay, now let's get down to the specifics of the 6-month plan. Okay, well, a 6-month plan includes sales plan, reductions plan, inventory plan, purchases, and maintain market plans, right? So the first phase of the 6-month plan will be the sales planning. Okay, so the first thing that we plan is the sales. Okay, and I said we are planning sales for both the seasonal total and each month sales, right? So in planning all these sales, the first step is planning the seasonal total sales. And we do this by adjusting what happened last year, so last year's seasonal total sales, for this year, using some trend that we project. we learned trends long time ago. A trend is a percent variation between two consecutive years, right? A positive trend means there is a growth, and a negative trend means there has been a decrease in the numbers, right? So when we have to project first the sales trend, okay, as compared to last year, how much increase or decrease are we projecting for this year's sales? That has to be planned out first, and based on that projected trend of sales, we are going to plan the seasonal sales dollar for this year, okay, knowing what happened last year. So here we are looking at an example 6-month plan, the sales part of the 6-month plan. Okay, so last year in February, we had a $60,000 sales, in March, $80,000 sales, April, $6,000 sales, etc. Okay, which added up to a total seasonal sales of $400,000. Okay, if we project that there is going to be a 5% increase, okay, an increasing trend, right? A 5% growth in sales in this year as compared to last year's sales, then we can add that 5% of last year's sales to last year's total sales. So that will be $420,000. How do we know that it is $420,000? That is, right here, it's showing the calculation part. So last year's seasonal sales were $400,000. If this year's plan is a positive trend, so 5% increase from last year's seasonal sales, then that 5% of $400,000 will be the 5% times $400,000. It's $20,000 that has to be added into the $400,000 to constitute $420,000 plan for this year's sales, right? Or we can do what's shown on this slide. So 5% increase from last year's sales, that would be 105% of last year's sales will have to happen in this year, right? So 1.05 or 105% times last year's seasonal sales, $400,000, which gave us $420,000. That was the case when we thought there was going to be a 5% increase as compared to last year, right? What if we project that there's going to be actually a decrease because of the economic condition that is very bad for us? We actually think there's going to be a decrease in sales as compared to last year. Okay, for example, 5% decrease. If that's the projected trend, then it will be 100% minus 5%, right? That's 95% times last year's seasonal sales, $400,000, will be this year's sales, which will be $380,000. So whether you project the trend to be a positive number or a negative number, you can apply that projected trend to last year's sales to be able to calculate what's going to have to be this year's seasonal sales dollar. So once we have the seasonal total sales planned for this year, now we have to break down the seasonal sales into monthly sales estimates. For us to be able to estimate our monthly sales dollar, we first need to plan the monthly percent distribution. Okay, monthly percent, sales percent distribution basically means how many percent of the total seasonal sales will happen in each month. Okay, this monthly percent distribution is planned based on history usually, and what happened last year, because we specifically operate on the calendar that has the same number of days and holidays for across different years for each month, and for that reason, what happened last year is the best kind of data that we can use to project what's going to happen this year. But again, there can be some, unusual, circumstances that might have existed last year, or that maybe that we're projecting that something special is going to happen this year that will make the last year's data not relevant. Okay, in that case, we're going to have a different projections, right? So whether we are basing our decision on the history or some special circumstances that we project that's going to affect our monthly sales, given all this information that we have our hands on, we're going to have to plan our monthly percent distribution, sales distribution. And based on that, we can apply that percent to actual dollars. And let's see some example here. Okay, so this is what we have so far planned. So we have planned the total seasonal sales $420,000 for this year, right? So that's the step one that we had. Now, step two, for us to be able to plan monthly sales, we first need to know the percent distribution, right? And let's say we are basing our decision on last year's history, and like take a look at the last year's number. Okay, last year, February sales were $60,000, whereas the total seasonal sales were $400,000. From these two numbers, we can calculate the percent distribution for February, which is $60,000 divided by $400,000, which is 15%, right? And we can calculate these kind of things for across all the 6 months. So now we know that 15% of the total sales occurred in February, and 20% of the total seasonal sales occurred in March, and 15% again in April, etc. Okay? Again, be reminded that this monthly percent distribution number, the sales percent, was calculated by dividing the monthly sales dollar by the seasonal sales dollar, total seasonal sales dollar of last year. And let's say that our plan is that this year's monthly sales distribution percent will be the same as last year's numbers. So we don't project any significant changes in terms of the, just the sales pattern across the 6 months. Then we just take and copy and paste the same the percent, the monthly sales distribution percent from last year. So we're going to have 15% of the total seasonal sales occurring in February, and 20% in March, 15% in April, etc. Just like what happened last year. Then based on this monthly percent sales distribution plan, as well as the total seasonal sales dollar that we planned for this year, we can calculate each month sales dollar, right, for this year, right? So for example, for February, 15% of the total sales will have to happen in February. So that means 15% times the total seasonal sales, $420,000, will be the sales for February, right? $63,000. And we can do exactly the same thing for the rest of the 5 months. And then we have the monthly sales dollar plans. Of course, once you make the total seasonal sales and as well as the monthly sales plan based on the history and projected trend, now the third step for sales planning will be making any kind of adjustment if as you see fit, right? So maybe there's some kind of special environmental changes in this year that are different from last year, that you project that April and May the monthly the percent distribution are not going to be exactly the same as last year, and we can change things like that. So for example, instead of having exactly the same percent distribution for April and May, which is what happened last year, you may, for some reason, you may project that the May sales are going to be more strengthened in this year as compared to last year, whereas the April sales are going to be a little bit slower. Then you can make the adjustment accordingly. So, like for example, increase the May sales to $66,000, which will be 15.7% in terms of the monthly percent on sales distribution. In April, you're going to have a little bit slower sales of 60,000, 14.3%. Something like that can happen just to fine-tune your monthly sales dollar plan. All right, so that has been it for planning sales. Okay, now that we learned how to plan sales and also saw an example, let's apply what we learned to this module problem assignment. Okay. In your module problem assignment 20, if you have it open in front of you, you will see that the first page of the assignment instruction is a 6-month plan chart, right? Which is what you're going to have to fill. There are a lot of empty cells that are numbered from 1 through 34. And all of these numbered cells will have to be completed, and that will be the assignment. And from the second page to the third page, you will see that the case for in which we are planning this 6-month of plan for is explained. Okay, and the first part is planning sales, 5 points for planning sales. Okay, this is the part that we're gonna work on right now based on what we just learned. Okay, so if you just take a look at the kind of the first 2 paragraphs on the page 2 of the assignment, it explains that you will be setting up a 6-month merchandise budget plan based on the following information and the information. So the kind of the setup or scenario, the case is given below, and you will have to complete all the blank cells, numbered cells, like I said earlier, in the chart on page 1 of the assignment. Okay. And while you're working on this one, and there are a certain cells that I would like you to actually give the work, the formulas, not only just give the answers, but also the formulas. So only those that I say show your work or rationale for your answers, those are the cells that you need to provide the work or formulas or rationale, explanation about your answer. For all the other cells, you can just put the final answers directly in the chart on the cells in the chart, and that will be perfectly fine. Okay, so for example, part 1, which is planning sales, you will see that at the bottom of the planning sales part, it says show your work rationale for the answers in the following numbered cells. And there are 1 and 2 and 3, right? That means if you go up to the first page of the assignment, okay, the number 1 and 2 and 3, like the sales part, then there are 4 rows of sales, right? Sales, the LY, which is last year. Last year's actual dollar, last year's actual percent, this year's planned dollar, and this year's planned percent, those 4 rows, okay? And there are a month, the fall season, August through January are given. And then the total column is all the far right side of the chart, right? So you can see the number 1 cell, the cell number 1 is the total sales this year planned dollar, right? Number 2 would be October's last year's actual percent, sales distribution percent. And number 3 will be like August this year's planned sales dollar, right? So, things like that. And there are number 4 and number 5, but you just need to, you will have to fill out the entire chart. So you will have to answer all the way from number 1 through 5 for sales, but you just need to show the work, the formulas that you use for only the number 1, 2, and 3, those cells. And in this case, you will actually see 2 cells that are numbered number 2, and 2 cells for 3, and 2 cells for 4. That's because their answers are the same and their formulas are the same. So basically, you're using the same thing. So they are not numbered separately, but they're numbered together. Okay. Given that, let's take a look at the actual case scenario for planning sales, which is on page 2 of your assignment. Okay. Or you can actually take a look at it on this screen as well that you're watching right now in the video. Okay, so a sweater buyer, consider that you are a sweater buyer. Okay, imagine that you're a sweater buyer and you're trying to set up a 6-month plan for this fall season, which is August through January. And the total fall sweater sales in last year was were $135,000. Okay, and the monthly sales distribution was as in the given table. So, as you saw in the table above, that's what the monthly distribution sales, the percent was. Okay, and this year, the buyer predicts that there's going to be a 10% increase in total seasonal sweater sales. So that is the projected trend, right? As compared to last year's seasonal total sales, this year there's going to be a 10% increase. And also the buyer predicts that the monthly sales distribution percent will be exactly the same in last year as the same in this year as the numbers from last year. Okay, so we can calculate what the sales distribution percent was in last year and just apply the same percent for this year for us to be able to plan each month sales dollar, right? So we are going to now work on completing the sales rows of the 6-month plan, which is sales number 1 through 5, all together. Let's pause the video here and work on the problem. Don't forget that you have to show the work for the cell number 1 and 2 and 3. Okay, all the other cells you can just work on them and on your own and just put the final answers in the corresponding cells on the chart. Okay, well, let's just work on the planning cells only for now, and later on we're going to talk about reductions planning, and then we're going to move on to the planning reductions for the module problem assignment. So until then, we're going to just right now focus on planning sales. Okay, let's pause the video, work on it, and come back to this video, and you will see the answer key for the 3 cells 1, 2, 3, to make sure that you understood how to work on those things. I'm not going to give you the formulas and work, but I will give you the answers so that you once you work on those cells, and you will know whether you got the formulas right or not by knowing whether your answers were correct or not. Okay, then if they were all correct, then you can apply the same thing for the rest of the cells that use the same formulas. Okay, let's pause the video here. Okay, so here is the answer key for cell number 1, 2, 3, right? Number 1 was $148,500. And second cell was 30%, and third cell should have been $7,425. Okay, if you got all of these 3 cells answers correct, then you probably are on the right page, so you can continue to work on cell number 4 and 5, which use basically the same logic or formula concept as the cell number 3. Okay. Okay, so now if you're done with completing the planning sales, the part 1 of the module problem assignment 20, then let's move on to the next step of the 6-month plan, which is planning reductions. Okay, again, just like the sales plan, reductions will have to be planned for the entire seasonal total as well as the monthly reductions. Reductions, as we already know, include markdowns and shortage, as well as the sales discounts, such as customer discounts and employee discounts. And so the reductions that we are planning here for both dollar and percentage will include all these 3 different components of reductions. You can think about a 4-step procedure to plan reductions. First, we have to plan the seasonal reductions, the total reductions first. And for the total seasonal reductions, you have to first understand what the total seasonal sales were and plan how many percent of the total seasonal sales will have to be planned as reductions. Okay, and which will also give us the reductions dollar plan for the entire season. Okay, once the entire seasonal reductions are planned, then the next step is distributing the seasonal reductions across the 6 months, just like what we did for the way we did for sales, right? So plan the seasonal total first, and then distribute that seasonal total dollars across the 6 months. Again, we will have to use the percent distribution, just like we did for the sales, right? The monthly percent distribution. In this case, it will be percent distribution for reductions. So once we have the reductions percent distribution planned out, then we can calculate the monthly reductions dollar based on that. The last step here is once we have already calculated this reductions percent distribution for the 6 months, so it's kind of like reductions percent, but these are percent of seasonal reductions total. Whereas, well, when we talk about reductions percent, it's usually reductions percent of sales, right? So the last step of planning reduction is to figure out what will be the monthly reductions percent of sales, out of sales. Okay, so there are going to be 2 reductions percentage numbers that we will have to calculate, as well as dollars for each month and the seasonal total. So we're going to work on an example problem in going through these steps. All right, so let's work on step 1, planning the seasonal reductions. I said before, for us to be able to plan the total seasonal reductions dollars, so how many dollars of reductions we can plan for the entire season of this year, we first need to know the seasonal sales dollar that we planned for this year and time that by reductions percent of seasonal sales that we plan for the season. So the planning process is the number one thing that you need to plan in terms of the reductions plan is planning the reductions percent for the entire season. So how many percent of the entire seasonal sales will have to be figured as reductions. That's what we need to plan first. And once you have that plan, then you time that by the seasonal sales to estimate the total seasonal reductions dollar. So for example, in the example that we have been working on from the previous slides, the planned seasonal sales for this year were to be like $420,000. And what if we have planned the seasonal reductions are going to be 5% of the seasonal sales? Then what will be the seasonal reductions dollar that we have to plan for this year? Right, so that would be for $20,000 sales times 5%, right? That would be $21,000. So that $21,000 are planned as reductions for the entire season of this year. All right, then step 2 of reductions planning is to plan the monthly reduction distribution percent, just like what we did for sales, right? Again, we are going to plan this year's monthly reductions distribution percent based on last year's result, which is a typical case. Now you look at what happened last year. Since we are operating on a calendar that has the same number of days and the same number of holidays or weekend days for across years, what happened last year in terms of the reductions. We take reductions, markdowns, and things like that on certain periods or certain days, right? So if you can compare what happened last year and kind of look at it as a benchmark for planning this year, it usually works. Across the 6 months, not every month has the same amount of reductions. So there are some months that have high reductions and there are some other months that have low reductions. And we can get this idea based on what happened last year. Okay, so we can first calculate the reductions distribution percent of last year based on what actually happened, right? The reductions dollars of last year, and then apply that for planning this year's reductions percent distribution percent. If we can utilize the assumption that okay, this year's reductions distribution percent will be the same as last year's reductions percent distribution, then we're gonna just copy and paste what happened last year. So for example, okay, let's say in last year we had a total reductions, entire seasonal reductions dollar of $20,000. And across the 6 months, in February, there was no reductions in the beginning of the season that we didn't take any markdowns or anything like that. And in March, we had a $2,000 reductions, and in April, $3,000 and $3,000 again in May, and then June, $5,000, etc. So let's say this was the case last year. Then we can calculate the reductions distribution percent based on these dollar figures. So for example, in February, reductions percent distribution will be 0%, right? Because there was $0 reductions. In March, there was $2,000 reductions. Since the total seasonal reductions were $20,000, we can calculate the March distribution percent by dividing the March reductions dollar, $2,000, by the total seasonal reductions, $20,000, which was 10%, right? And we can do the same thing across the other months, 4 months. And in this particular example, we have 10% of the total reductions occurred in March, 15% occurred in April and May, and 25% in June, and 35% in July, which all add up to 100%, right? Then, using the assumption that this year's reductions percent distribution will be the same as last year's reductions percent distribution, we're going to just copy and paste the reductions percent from last year for every month to this year. Now, step 3 is now planning the monthly reductions dollar based on this reductions percent distribution plan, right? So we've got the reduction percent distribution plan for February through July, and knowing that this year's reductions, seasonal total reductions dollar, which we already planned earlier, was going to be $21,000. And then we know that 0% of this $21,000 should happen in February, and 10% of the $21,000 will be allotted to March reductions, etc. So for March, for example, 10% times $21,000 for the total seasonal reductions, so that the reductions for March will be $2,100. Okay. For July will be 35% of the seasonal reductions, right? So 35% times $21,000, so that will be $7,350 reductions are planned for July. So for each month, the reductions dollar can be calculated by taking the total seasonal reductions dollar and multiply that by monthly reductions distribution percent that we plan for this year. Now that we plan the monthly reductions dollar for all 6 months, okay, the next step, the final step of reduction planning is to now calculate the monthly reductions percent out of that month's sales. Okay. So for us to calculate these reductions percent numbers, we will first need to know the sales of that month too, right? We had planned the sales for each month earlier, so we take in those numbers as we see on the screen now on the second line in black font. And then we kind of compare these reductions dollar that we plan for this year and the sales dollar we plan for this year for every month, so that we can calculate the reductions percent of sales. Okay, so how many percent of that month's sales are going to be planned as reductions? Okay. For example, for May, the reductions dollars were planned to be $3,150. The sales planned for May in this year were $63,000. So that means the reductions percent of sales, okay, that reduction percent will be $3,150 divided by $63,000. That will be 5%. So this monthly reductions percent figure is different from the previous reductions percent figure that we looked at. Previously, we looked at reductions percent distribution, which is basically reductions percent out of the total seasonal reductions total, right? Whereas for calculating this reductions percent number is the percent of sales. So we're going to have to look at month by month. For each given month, you have to look at the particular month sales planned out and look at the reductions dollar planned and just take a ratio of that, so reductions dollar over sales dollar, and that will give us the reductions percent of sales. So in this manner, we can calculate reductions percent of sales for all 6 months. And take a look at the total part. Total column, the reductions percent of sales is given as 5%. Okay, if you do the calculation, which is $21,000 over $420,000, that will be 5%, right? But also remember that in the previous stage, the step 1, okay, of planning reductions, we said we plan to have a 5% of sales to be reductions, right? So that was based on the plan. Okay, so this 5% is a planned figure, initial planned figure, and also we're confirming that number by doing the calculation of monthly reductions dollar over monthly sales dollar. In this case, it's not month, it's the total reductions dollar over total sales dollar, and we can confirm that our plan was used correctly. All right, so let's practice what we learned by working on the module problem assignments, the part 2 of the assignment, which is planning reductions. Okay, so this case continues from the what we saw before for planning sales. Okay, so the sweater buyer, okay, we are now planning reductions, retail reductions for this fall season. Okay. Considering the market environment, the buyer projects that the total reductions of this fall will be 8%. And that will be the 8% of the seasonal sales, right? The entire seasonal sales. Okay, and this year's monthly reductions distribution, okay, will be the same as last year's again. So that distribution percent of seasonal total reductions will be the same as last year. So for every month, we can calculate, or we are given last year's distribution percent, and we apply that for planning for this year. Okay, so let's complete the reductions rows of the 6-month plan, which basically correspond to cells number 6 through 12 in the 6-month plan chart on page 1 of the assignment. Okay, again, we see that number 11 was used for 2 cells. That basically mean both cells will have the same answer and use the same formulas and things like that. Okay, so let's work on it. Beginning with number 6, which is planning the seasonal reductions dollar. Knowing 8% of the seasonal sales will be reductions, we can plan that number, and then we can distribute that across the different months to plan the seasonal the reductions dollar for each month. And then for number 10 through 12, it's to calculate reductions percent of sales. And that means you have to first know the reductions dollar planned for this year. And then you look at the sales that you planned for that particular month. And then utilize those two numbers, sales and reductions for that month, for each month, to be able to come up with the percent of sales, which is the last line, last row under reductions. Okay, well, let's pause the video here and work on it. And remember that we have to show your work or formula for several cells. In this case, cells number 6, 7, 10, and 11. For those cells, you're going to have to show not only the answers, but also for your work or formulas rationale for the answers. Let's pause the video. Okay, here are the answer keys for the 4 cells, number 6, 7, 10, 11. So take a look at the answers and compare that with yours and make sure that you got the right answers. Alright, so far we have learned how to plan sales and reductions. Now is part 3 of the 6-month plan, which is planning stock levels. We have already learned how to plan stocks, I think 1 module ago. We learned 3 different methods of stock planning that included the SSR method, the basic stock method, and the week supply method. Among those 3 methods, the SSR and basic stock method are applicable to the 6-month plan. If you can remember, the week supply method is used for planning stock levels for very staple merchandise whose sales are stable across different weeks and different months. So given that their sales are the staple merchandise sales don't really change across months, you don't really need to have a monthly plan, 6-month plan, because your plan is going to be pretty much the same across all 6 months, right? So for that reason, the 6-month plan is more useful for merchandise whose sales are tend to fluctuate across different months. And so the SSR method or the basic stock methods are more applicable. For the SSR method is more, obviously we already know that it's more for fashionable merchandise, whereas the basic stock method is more for more basic merchandise, and the turnover, when the turnover is very low and slow, right? So depending on the characteristic of your merchandise, you may either choose to use the SSR method or the basic stock method. Whichever method you use, the first thing we planned to be able to plan stock levels is the efficiency measure. Okay, the SSR method uses the SSR or stocks to sales ratio as the efficiency measure, whereas the basic stock method relies on turnover as the stock efficiency measure. So we first plan the level of efficiency we want to have on with our inventory investment, and then based on that planned stock efficiency level, we are going to be able to now plan the beginning of month or BOM stock level in terms of the dollars. All right. Alright, so let's take a look at an example of planning BOM levels using the SSR method here. Okay, so we're continuing with the example setup that we have been looking at from the sales and reductions plan before. So now that we had monthly sales planned out, okay, the first step for planning BOM level will be to plan the SSR, right? So across the 6 months from February through July, we're gonna have to plan the SSR. So for example, the February planned to be the SSR was planned to be 1.5. And March 2.0, and April 2.5, May 2.0, June 1.5, July 1.2. So let's say this is our plan. And these SSRs usually are planned based on what happened last year. And if you have any, remember that, things went really fine last year, you didn't feel like you were short of stock and the sales were supported well with your stock, things like that. And you may just base your decisions of the SSR, monthly SSR, on what happened last year, right? We kind of learned about it before. If you have a vivid memory of something not going right last year, and for some months you were really short of the stock at the beginning of the month, something like that, then you probably would like to have a little bit higher SSR for this year, right? So, whatever reasoning that you use, you can have different SSR planned out for the 6 months. Okay. Then, given this SSR, that numbers that are planned for each month, then you're gonna now have to plan your BOM, the beginning of month stock level, by multiplying your planned sales by planned SSR, right? SSR basically means stock sales ratio. So the SSR of 1.5 in February means the 1.5 times of your planned sales will have to be stocked at the beginning of the month in the store for you to be able to support that $63,000 sales. So utilizing that concept and formula, your BOM for February will be your February sales of $63,000 times the SSR planned for February, which was 1.5. That equals 94,500. And that is the BOM planned for February this year. And you can utilize the same formula for planning the BOM levels for all the rest of the season for every month. Okay, so we just took a look at the way we plan BOM levels using the SSR method. So then now, what if we wanted to use the basic stock method? Then how are we going to go about doing it, right? For the basic stock method, we know that the planned BOM will be basic stock plus the planned sales for the month, right? We had learned about it in the previous module. And we also learned that basic stock means it's the average stock minus the average monthly sales, which basically average stock is just the seasonal sales divided by the seasonal turnover. And the average monthly sales will be the seasonal sales divided by 6 months, right? So with knowing all these things, we can apply it to plan the every month BOM using the basic stock method. For example, let's say in the given case that we've been looking at, let's say the turnover was planned to be 4.0, okay? If that's the case, then what would be the planned BOMs for February through July? So we are going to have to take the seasonal sales of $420,000 divided by the seasonal turnover of 4, okay, minus the seasonal sales of $420,000 divided by 6 months, and that part, if you do this calculation, that is what we call basic stock, and then plus basic stock plus the sales of that month. So for February it will be $63,000. So basic stock plus $63,000 will be the BOM of February, which in this case came up to be $98,000. So for planning for all 6 months BOM, you first, we need to calculate what the basic stock is, given this formula. And then you add in to the basic stock the every month, the particular month sales planned for this year. Then you can come up with the BOM stock level for every month. as you can see here, now we have calculated the basic stock for all the way through July. And you can see that February and July and April are having the same sales, 63,000, 63,000, 63,000, or May too. So if the 4 months have the same sales, that leads to the same level of BOM stock, right? Because BOM stock is basic stock plus the month sales, right? The basic stock is applicable all through the 6 months altogether constantly, and then the amount of the BOM stock will fluctuate based on your sales. And because you have the 4 months that have the same sales, amount of sales planned out, their stock levels are planned to be the same too. And March and June are the same. They are sharing the same sales amount, right? So their stock levels are going to be the same too. Okay, so whichever method, whether we use the SSR method or the basic stock method, we are now able to plan the BOM levels, right? So now that we have the BOM levels, then how do we plan the EOM levels? Okay, we have learned a very, very important concept or about the relationship between the BOM and EOM. Can you remember that? The relationship is that the BOM of a month is the same as the EOM of the previous month. Okay, another way of saying it is that the EOM of a month is the same as the BOM of the following month, right? So now that we have all the BOMs for all 6 months, we can easily estimate the EOM of the first 5 months by using the EOM of the following months, right? So for example, the EOM of February will be the same as the BOM of March, and the EOM of March will be the same as the BOM of April, and etc. So we can calculate the EOM for all the way through June in this case, but for July, the last month of the season, okay, how do we know the EOM? Okay, we can't use the BOM of August because August is not planned yet and it's the next season, right? It's a different season. We're not including it in this 6-month plan. So how are we going to be able to plan the EOM of July, the last month of the season? There are a few rules that we can apply here in planning the last month EOM. Okay. First rule is in case we don't want to make any purchases in the last month of the season. A lot of times we may be a little bit less willing to make purchases because we only have like less than a month left for the season, right? If that's the case and 0 purchase is planned for the last month, then the EOM for that last month has to be the BOM minus sales minus reduction. Whatever BOM that you started the month with, okay, and subtract your sales that you made and any reductions that you had to reduce, and then what's left is going to be your EOM, right? And just given that concept, we can kind of think about a formula such as this, like EOM equals BOM minus sales minus reductions. And this is only applicable when no purchase is planned for this last month. Then what if you don't have such a plan? It's not like you're planning to not make any purchase. So, you may still plan to make purchases. If that's the case, then how are we going to be able to estimate the last month EOM? Okay, a lot of times we may use the average inventory, because average inventory is the average level of inventory across all 6 months. So if we just utilize that, that may be a kind of safe plan. Or if we have a pretty good idea about what the BOM of the following months, or which is like the beginning of the next season, the following season is going to be like in this example's case, if we know the BOM or have some idea about the BOM of August, for example, then we can kind of utilize that estimate as the EOM of July. So kind of using an arbitrary EOM stock level that is considered more appropriate given the scenario, given the circumstances you are working on. So there is no one rule for planning the last month EOM, but you have to think about various kind of cases and plans for you to be able to project this EOM of the last month in the most appropriate manner. Alright, so now it's time to work back on the module problem assignment again, and now it's time to work on part 3, which is planning BOM and EOM stock level. In this module problem assignment, we are going to be asked to use the SSR method, right? So the sweater buyer is now planning inventory levels for each month using the SSR method. So remember that it's going to be the SSR method. And the monthly SSRs of this year are planned to be the same as those of last year. Okay, so the table on the first page presents last year's SSR. And this year's SSRs are going to be the same as last year's numbers. Okay. And for this exercise, to calculate the January, which is the last month of the season, the EOM of the January, we're going to assume that the buyer plans to make no purchases. Okay. So we have just learned different cases of the last month EOM planning, right? So we are going to utilize the case where we are not going to make any purchases. Okay. If that's the case, then how are we going to calculate this last month or January EOM? So you have to think about it, okay? So let's complete the BOM and EOM rows of the 6-month plan, which correspond to the cell numbers 13 through 20, okay, on page 1 of the assignment. Okay. Remember that you need to show your work, formulas, rationale for the answers in the 3 of the cells. So cell number 13, 15, 20. For these 3 cells, you're going to have to show your work. Okay, let's pause the video and work on the problem. Alright, so here I'm sharing the answer keys for those 3 cells, the cells 13, 15, and 20. See if you got these answers correct, and if they are, probably chances are you are on the right track to fill out the rest of the cells as well. Alright. Alright, so now we're continuing to move on to planned purchases. So far we have planned sales, reductions, and EOM and BOM levels, right? And all these numbers are going to be utilized to plan purchases for every month, each month, and as well as the total. First, to plan purchases at the retail value, okay, we have for each month we have the sales plan or net sales plan, and we have EOM plan, reductions plan, and BOM plan, right? And utilize these numbers, and the formula for planning purchases at retail will be sales plus EOM plus reductions minus BOM. Okay, if you think about it, okay, sales, we need this much of merchandise. EOM is what we need to leave the month with, so we obviously need this merchandise. Reductions is what the value of the merchandise is going to be reduced as much as this reduction. So we initially, at the beginning of the month, we probably should have had this much more value so that we can afford to reduce the value of the merchandise, right? Then BOM is what we already had, right? What we started the month with. So the first 3 things, sales, EOM, reductions are what we need, and BOM is what we already had, right? So what's the difference between what we need and what we already had will be what we need to purchase more, right? So out of the BOM, we make sales and and reductions, and we also need to leave this much EOM. And to cover that, we need to make purchases, new purchases to fill in more merchandise. And that's how this formula came up about. So sales plus EOM plus reductions minus BOM of each month. So if you're planning purchases for February, then you're going to have to take the sales of February and the EOM of February and add in the reductions of the February that you plan minus the BOM you plan for February, and that will give us the planned purchases at retail value for February. But we also want to know the cost value of the purchases, because the cost is what we actually are going to pay to the vendor, right, when we make the purchases. So we need to know the cost value of purchases as well, because this is the capital need that we have for that particular month, right? So once you have planned purchases at the retail value, we can easily estimate the cost value of this planned purchases amount by knowing the markup percent, right? Retail times 100% minus markup percent equals cost value. Now, this is one of the three most important RCM relationship formulas we have learned before many times, right? So we apply that logic here. So planned purchases at retail times 100% minus markup percent. In this case, it's initial markup percent, and that's going to give us planned purchases at cost. So continuing with the example that we have worked on, say so far we have planned sales, reductions, and BOM and EOM, and we laid out all of the numbers that we have already calculated so far. And now to plan purchases at the retail value, we know the purchases will be sales plus reductions plus EOM minus BOM, right? So that will be, for example, for February, that will be sales of $63,000 plus the reductions of $0 plus the EOM of $168,000 minus the BOM of $94,500. So that lead to the planned purchase at retail of $136,500 for February. And we can do the same kind of calculation for the rest of the month. So using the same logic, sales plus reductions plus EOM minus BOM. Then what if the total? Okay. For total, you cannot just look at the columns because we don't have the BOM and EOM for the total figure, right? So the total for total planned purchases for the entire season, okay, for you to calculate that, you're going to have to add up all the planned purchases for February through July, all 6-month planned purchases together to sum up to know the seasonal total of the planned purchases. Okay, now that we have all the retail value of the planned purchases, now let's do the planned purchases at the cost value. Okay, and the cost value is equal to the retail value times 100% minus initial markup percent, right? What if the initial markup percent was 54%? Then for February, for example, that will be $136,500 planned purchases at retail times 100% minus 54% IMU percent, and that will be your the cost value of the planned purchases for February, which was $62,790. Okay, and we can do the same kind of calculation across all 6 months. And as well as to calculate the total, for total, you can either multiply the planned purchases at retail for total entire season or total times 100% minus IMU percent. You can do it that way, or you sum up the entire all the 6-month planned purchases at cost, and that way you can also calculate the planned purchases at cost. Either way, you should get the same answer. All right, so now let's get back to the module problem assignment. Okay, now we are about to work on part 4, planning purchases, right? The scenario continues. Now the sweater buyer needs to set up a monthly purchase plan based on the projected sales, BOM reductions, and EOM for this year that we planned already. Let's say the initial markup goal for this fall season is going to be 55%. Okay, so initial markup is 55%. And let's complete the purchases at both retail and cost. Those purchases rows of the 6-month plan, they correspond to the sales number 21 through 28. Also remember that you have to show your work for 4 of the sales, 21, 22, 27, and 28. Those sales, you're going to have to show your work in this on this third page of the assignment. Okay, so let's work on this. Let's pause the video. Okay, here are the answer keys to 4 sales, 21, 22, 27, and 28. I hope you got all of them right. Just make sure that you got them right before you move on to the next part. All right, so now we are reaching the final part of the 6-month plan, which is the maintain markup plans. Okay. So, given all the sales reductions and the inventory level plan and purchases plan and everything, now we want to know what if everything goes as planned? Okay, then what kind of markup can we achieve? That's the kind of the performance that we're gonna have if we go with our plan. So making sure that our plan is according to our gross margin goal or our markup goal. So we are going to have to calculate maintain markup in both percentage and dollars, and we start from the percent. So project the monthly maintain markup percent first, and then based on the percent, we're going to calculate monthly maintain markup in dollars. First, to plan maintain markup percent, recall the maintain markup percent formula based on the initial markup percent and reductions percent that we have learned under markups before. So maintain markup percent is equal to IMU percent, initial markup percent minus reductions percent times 100% minus IMU percent. Do you remember this formula? Okay, so we know what the initial markup is. We already used the initial markup to calculate planned purchases at cost from the planned purchases at retail, right? So by this time, we would already know what the initial markup percent is. And also we know the reductions percent for the season, right? So, also we know the reductions percent for each month. We already have planned or calculated reductions percent for every month in a prior step of the 6-month plan. So we've got the figures. We just have to utilize these two numbers to come up with our MMU percent. Remember that we actually did calculate reductions percent in two ways, right? The first reductions percent was reductions percent distribution, which was reductions percent out of the seasonal total reductions. Whereas the second reductions percent was percent of sales, right? In the formula for MMU percent, the reductions percent in this formula, it means reductions percent of sales. We have learned that before. So that means we have to utilize the reductions percent that's calculated based on the reductions dollar for the month and divide that by sales dollar for the month. That reduction percent out of the two different kinds of reductions percent that we have planned, the reductions percent of sales is what we need to use to calculate MMU percent at this stage. From there, once we have the MMU percent calculated, then we can plan the MMU in dollars by multiplying the MMU percent by the net sales for the month. Because MMU percent, maintain markup percent, is percent of sales, you can calculate the MMU dollar by multiplying the percent by sales. Okay, so we know the sales plan for the month, and we have MMU percent plan for the month, then we can easily estimate what would be our maintain markup dollars for that month too. All right, so let's work on an example. We're continuing with the case we've been seeing so far. So far, we have found that March sales in this year are going to be planned to be $84,000, and March reductions are going to be $2,100, and the IMU percent we used a 54%, right? Given this data and this planning, what would be the maintain markup percent and maintain markup dollar for March? First, we had already calculated the reductions percent of sales for March, which was 2.5%, but just revisit how we calculate this number. It was reductions dollar of March divided by the sales dollar of the month of March that we planned for this year. Knowing this reductions percent, now the MMU percent for March will be IMU percent minus reductions percent times 100% minus the IMU percent. So that's 54% minus 2.5% times 100% minus 54%. To work on this calculation, we first have to do the parenthesized part first, right? So that's 100% minus 54%, that's 46%, times 2.5%, and then subtract that answer from 54%. I had recommended earlier for this calculation that it would be best if you just utilize decimals for everything. and then just convert the final answer into a percentage figure, and just to avoid any miscalculation, because it's very easy to make a mistake in the bracketed part. All right, so now that we know the MMU percent, the MMU dollar will be MMU percent times the sales of March, right? That we planned $84,000 times that 52.85% MMU percent that gave us the idea that the month of March we are going to maintain $44,394 of markup if everything goes as we planned. All right, so let's get back to the module problem assignment. We are on the last part of the assignment, part 5, which is a maintain markup projection. Okay, so the case continues. Based on the 6-month plan created so far, the sweater buyer is now trying to project monthly and seasonal maintain markup percent and dollar for merchandise planned for this fall season. Okay, makes perfect sense. So let's complete the MMU rows of the 6-month plan for both percent and dollar that correspond to sales number 29 through 34 of the chart on page 1. Okay. Also make sure that you show your work or rationale for 4 of the sales, 29, 30, and 33, and 34. Okay, and those sales. For every month, we have already learned how to calculate MMU percent in dollars. You just apply that. For the seasonal total MMU percent and dollar, you basically can apply the same logic as if you were calculating for each month. So you can look at the reductions percent of sales for the entire seasonal total and the seasonal total sales, in using those numbers to be able to calculate MMU dollar and MMU percent. Okay. So let's work on these. Let's pause the video. And here's the answer key for the 4 sales. Okay, so 29, 30, 33, 34. Okay, make sure that you got the right answers to assure that you are on the right track. I hope working on the module problem assignment simultaneously with watching the lecture video actually helped you practice the 6-month plan a little bit better. It is a pretty complex plan, but it's definitely doable. Okay. A 6-month plan is a very important thing for merchandisers and line managers and product line managers, and as well as designers, because the 6-month plan provides the cash flow information and merchandise flow information. The entire season is basically planned. In a company, like the time when you plan, you set up the 6-month plan is very exciting time and very stressful time as well, because you have to think about a lot of different factors to go in the planning of the reductions percent and the sales trend to be able to plan the sales, and the SSR or turnover plans, and all these very, very important merchandising planning numbers are going to be considered and planned for the 6-month plan. So this is a very, very important part, and 6-month plan allows the company to determine all the cash needs and the merchandise needs, and so it's a very important part of the merchandiser's job. All right, so this concludes module number 20. It has been a long module, I know, but again, it's a very important module. And I hope that you have already completed your module problem assignment number 20 while you're working on and watching this video. All right, thanks for listening. Bye.